Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to expand on our macro events discussion from last week. Matt made some new charts showing the implied move versus the actual volatility. Do you want to share those, Matt? Share your screen and get us started.
Sure. We didn't have any trades, so let's dive right in. This is I'll just review what we talked about last week. I think it's a very nice analysis, especially for more people trading shorter term options. One of the things that you want to think about, often people will avoid FOMC, avoid Federal Open Market Committee days because there's so much volatility. Well, we wanted to study that and see if there are any other days that we might avoid or profit from. So there's a few things that we're actively working on here, and we wanted to present it to you as soon as we got the information. So the first graph is the one that we presented last time. It basically shows the expirations, and then the blue line is the implied volatility surface or skew term structure. Now, the first thing that we do is solve for the weekend and holiday effects. So as I mentioned before, business days doesn't fit very well, meaning the Monday is still different, much different from the Friday. Calendar days are even worse, so you want to do some blend, something in between a business day and in between calendar days. And so we've come up with a percentage that kind of varies, but it solves for that. So it smooths out each day, but then you could still see there are bumps in here, Tyler. And those bumps represent usually either macro events, or we had a few comments of people saying, well, NVIDIA's earnings came out between the 26th and 27th. So that had something to do with it. So that was kind of interesting.
Yeah, very interesting to see this. If you guys want more details, you can watch our show from last week. So I think this week, Matt, do you want to talk about kind of the historical side of this, and do you have any graphs to show that?
Yeah, absolutely. So what we've done is we've gone through and we said, okay, well, there's a 56% additional volatility to make that bump. And then we apply that to each one of these macro events that happen on that day. So GDP, jobless, durable goods. And then we did that for every day going back to 2023. And then, so here's 100% that goes to non-farm payrolls, unemployment and such. So that's the backdrop for it. And then what we did is I said, well, what are the largest macro events? And then we'll look at what's implied. That's what we saw earlier. And then what we did is we overlaid actual volatility. Now, ORATS has a way to calculate volatility that can get a one-day volatility. So if you use close to close, you can't do this type of analysis. But if you use what we use as a modified Parkinson one-day historical volatility, and then we can use open, high, low, close, and then we adjust it to our old tick data calculation that I thought was very accurate, and it actually overlays it very well. So we have the one-day Parkinson, or ORHV1D is how we label it. It's the ORATS historical volatility. One day is the red line, so that's what we call actual, and then the implied average moves are the blue bar is going up. So they're slightly different axes. So what you want to do is so when we say 2.5, that means it's 2.5 times normal, or 150% over. So that's a huge implied move for, and again, People avoid FOMCs for a good reason. They're very volatile. And so we see here on this graph, Tyler, that not only are they implied the highest, but they actually produce the highest implied volatilities. The only one that's higher is a related thing, the press conference that the Fed has. So those are the biggest implied and the biggest actual volatilities, Tyler.
Interesting. So why that's interesting early on in the graph. Now, what happens later on in the graph? Like why is there a bigger gap?
So then what happens is we start. I've sorted these by the largest implied moves. Okay, so and then I've overlaid the red is the kind of actual moves. So if there's a big implied move and not so big of an actual move, that that kind of says that the market might be over implying a move on that particular day.
Gotcha.
The leading economic indexes month over month is one such day. Bank of England's consumer credit is another one that's kind of implied highly, but doesn't really produce. And then on the flip side, this is the Fed press conference and interest rate decisions, so those move a lot. But here's one, the current account, like that's current account deficit that's announced. That moves a lot more than is implied, as does non-farm or non-manufacturing PMIs. They do quite a bit. So then you might say, well, okay, well, how do I use this, right? So then what we do is we say, okay, well, what you want to do now that you know that is you could then look at what's upcoming. So you could see like on the 7th, there's average hourly earnings. This is just a spreadsheet. We're eventually going to make it prettier. For example, in our market intelligence, we have a macro calendar that's pretty cool. So you can see like the 5th tomorrow, and you could click on that at 10 a.m. Unemployment changes. So here's that PMI that we saw before. And then on Friday, there's quite a bit. There's hourly earnings and unemployment stuff. So, some of the things that the next step that we're taking these is to then backtest on days that, for example, have a large, if it shows up, let's just say earlier in the week. So this is something that was 11 days in the future, and we were seeing the market already preparing for it. So what I'm doing now, Tyler, is my kind of current thing is to test on the days that we've identified as big days. So in this case, there are 2 days, the 27th and the 7th. So what I would do is put those in one date file and then put all the other dates in this range in another date file and say, is a back test of any particular strategy work better in one or the other? Does that make sense?
Right. Yeah, that would be interesting. So it definitely applies to the world of back testing, which we do a lot in. How does it apply to the world of scanning? Like, should I be looking out for this if I'm just looking for a trade today? How does this impact my trading?
Well, you're going to want to be careful. What I'm finding is that in my initial back test that I'm doing, so the back test is for your scanning. I mean, you want to, when you're back testing, you want to back test what you're going to scan,
Right.
which is to say, do you, like if you normally trade, I don't know, an out of the money iron condor, how does that perform on these various days, and what, where should you draw the line between where you should trade and where you should avoid? So that's the big thing that we want to do is find what my theory is right now, and it's proven out in some initial back testing, is that when you identify these days, especially consistent days that the market is implying moves, those are some days that you want to avoid. And then eventually we're going to start looking at, so we could set up entry and exit days around all these dates. So we have all these dates historically, as we see here. And so we could set up, buy and you could get pretty granular with that. We don't want to get too granular, but this is still important, especially like, you might say, on these ones that move a lot that aren't implied, that might be one type of a strategy. And then another strategy might be when they're over implied and they don't move that much. So those are some things that we could test as well. So there's a lot that you could do. We want to try to bring to our clients the important ways to treat these types of strategies. In many times people, like I said before, will avoid FOMC, but this might say avoid, other days as well, especially
Right.
the days that produce some more volatility.
Yeah, no, definitely. I was thinking, I wonder if this could go in our scanner as a theoretical edge, like use these factors to create a volatility surface and then derive a theoretical price from sort of a adjusted volatility surface based on the macro events.
Yeah, so you bring up a good point, and that's really insightful, because one of the things that we do already is when we come up with our forecast, for example, of volatility, we do a forecast of what we think the volatility should be for Apple or for many stocks, and then we create a forecasted surface that does change, based on when earnings are coming up. So, for example, if we'll go to some upcoming earnings, like Broadcom, we're going to do an article on that. So let's take a look at Broadcom. So Broadcom, when I checked before, yeah, it's pretty overvalued. So, it's 8.9% implied earnings move when the average is 5.8. So we thought that this was a pretty big, overstatement of volatility. So when you look at the options chain for Avgo, you'll see that, of course, you're going to see higher volatilities here because earnings is coming up. But then you'll want to go in and look at, what the forecast of volatility is. So the implied volatility happens to be, where is it? So it's much less. So 59 for the forecast vol, and the vol in the market's like 80. That has a lot to do with how much implied move there is right now. So if you go out farther, what I expect to see is the volatility being, our forecast being much closer. So our forecasts are like 49, and the SMV is 45. So what that means is we think that Broadcom, we forecast their volatility at a decent level, but especially the front months, those are high. So what that would say is in an option scan, as you talk about, and let me just see if I have an earnings scan that we could look at that has Broadcom in it. This is a double diagonal. It only has KR, so let's go AVGO. So what you will hopefully see is that the calendars for Broadcom, this happens to be a double calendar. So the implied volatility of the 4-day is very high, and the implied volatility of the 39-day is quite low, and there's quite a large forecast edge, because as we looked at in the detail in the chain, the forecasts are beneficial on the far outs and has edge for selling the front. So that's why you see such a large forecast edge on these, Tyler.
Right. Yeah. Yeah. This would be great to include the macro event calculations into the
Yeah,
forecast edge, or maybe a whole new edge entirely.
yeah. So why don't we actually throw that up as a trade here? We'll give them a
Yeah.
few cents.
See how the forecast edge performs in the real market.
Yeah, for the Avgo earnings. Let me try that one more time. When we force it, you need to have it equal to that. So there it goes. There we go. All right, and then again, so that we'll be able to follow this, Tyler, in our trade journal that we are teasing out. We're having a beta users try it out, and so it's been quite interesting.
Yeah.
And so I will put an alert on there so it reminds me that I got this going. And I am paper trading based on T-Hub forecasts. I like to put the notes why we chose this, and in this case it was, you know, in reference to what you were saying, you know, the way to use this kind of macro events like in earnings. And what we do in earnings is we strip out the earnings events and forecast those separately. So you want to, when you're trading, you want to look at those separately. If you can't, it's a lot of work, but you look at and forecast the underlying volatility. For example, we'll go back to Avgo in the earnings. So, you know, one neat thing is that we look at inner earnings HV and IV. So inner earnings, the implied volatility between earnings dates somewhere in the 33s, and the historical volatility somewhere in the 38s. So that helps determine our X earnings forecast of volatility. And then on top of that, to get to the forecast, we'll add in uh, the earnings effect. And the earnings effect, as you will see here, increases as the days to expiration become closer because it has more effect on the shorter amount of days than the longer amount of days. But you could see it kind of, you know, asymptoting here and then exponentially going up here. And that's the effect of the earnings coming up. And that's the effect of people understanding what the normal historical volatility is and then trying to put a trade around that. So that's how that would work. And then you could do this for the broader markets. You know, for example, SPY, you can, you know, start to take out some of these bumps based on these earnings events, and then look at the earnings event separately, which is what we're starting to do with this type of analysis, Tyler.
Right. Yeah. Yeah. This is great. I love seeing a new way to look at the markets, especially SPX and SPY, which, you know, we see a lot of our users going after those symbols. And we have a lot of earnings data for, you know, a lot of the popular symbols like Nvidia and Apple, and we have a lot of users on those. But also this, it's great to see some work being put into more analysis on SPY and SPX.
Yeah, and it's a good analogy because that is how we'll probably end up using this type of information and presenting it in an earnings type table. So you see there's nothing here for earnings for SPY, but what we can do is start to put some macro events in there, because and then start showing some of the information, you know, in addition to, this is a really cool graphic that you came up with, Tyler, but now we could overlay it with some you know, actual moves versus, this is an importance, but we have a lot more data now, so we could augment this and then, you know, potentially overlay it with some of the implied trade builder stuff, and really have kind of an interactive chart where you could see where there might be edge. You could, you know, download these dates out of our data and then upload it into our backtester. So we're going to have entry and exit dates, so you could trade around that and see what type of strategies you want to avoid or which ones you want to do, during these times. So there's a lot of opportunity, and this is the level of analysis that things are at right now.
Yeah, I'm really excited for some of the new stuff we're building with back testing and signaling, and this new stuff with the macro events. So it's great to see, and it's all because of your guys' feedback. A lot of you guys watch the show and you give us feedback on what we can do better and the tools that you want to see built. So we always listen, and we work on stuff quite a bit based on your feedback. So thank you.
So Tyler, this looks like a breakout of your kind of trend lines. So it looks like we're breaking down. This is not good for the market. So vol's going up, which is not good. And so let's just check a couple things. This is the market, showed itself this morning, opening up in the morning, and now it's really coming down. But what we're seeing on our outlook page is implied volatility going up. That's not very good for the market. We're showing the implied volatility versus the components way high, so that's not good for the market. And then of course, contango, one of our favorites to look at, which is when the front month is this much higher than the back months. You could see it's nearly as high as back in November when the market came down. And then also in a put call slope, that doesn't really tie in too well to all this other stuff, but it does tend to flatten out after a big move. So, kind of an interesting time for us to be on the air right now, Tyler, when the market's really melting down and having some, I would call this pretty large volatility signals going against it. So this looks pretty ugly right now.
It does. What's interesting about that second chart there is, it's kind of expecting the chart itself and the data behind the chart sort of expects that solid line to revert to the moving average, which is that dotted line. So it actually is showing that we're bearish on IV because we're sort of expecting that to revert to the mean there, which is interesting.
Yeah, well, the IV is very high, but so this is.
Well, we're looking at like a 10-day forecast here. So if you scroll all the way up, there's that over the next 10 trading days up at the top left.
All right.
Yeah. So it's kind of looking at a 10 trading day forecast. It doesn't usually change much unless there's more nuance in the data, but it kind of adjusts the forecast a little bit. What it does, it sort of does a quick back test of how the data is correlated to where it's going to be in 10 or 20 days. And then it'll present to you a forecast there.
Yeah, I mean, for me, I just know that when volatility is rising, that's negatively correlated. So especially this component versus SPY, that's another really good look at the market. And we've been showing it really coming off, since like even right before the sell-off started. So I wouldn't look to get back in until this corrects and comes down. Contango's positively correlated with the market, so contango's coming down, the market's coming down, and that actually started pretty early too. So we did have some eyes on this as things were happening.
All right, great to see, Matt. Thanks for the new chart for the macro events. Do you have anything else for today?
No, but that's good. That's a good show.
Yeah. No, yeah, it's great. And, we got some new stuff coming out, and we're very excited to share. The trade journal is currently in beta, so if you guys want access to that, just email us at support@orats.com. It connects to the paper trading account, so you guys can see all your trades from there. Well, if there's nothing else, Matt, thanks, guys, for watching the show. If you guys have any feedback or questions about the dashboard, just email us or write a comment below. Thank you, Trader, for hosting. We'll see you guys again next week.
Thanks, Todd.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.